This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
First of all, margin and relevant costing. The typical subjects that could be asked here. Find the best use for restricted resources. You've got a restricted amount of material available or labour available. How should it be best used? Which products should we direct it to first? To price special contracts. To make continuation closure decisions, perhaps for a plant or an outlet, or indeed the operations in a whole country, and then make and buy decisions. First of all, we have to know what a relevant cost is. How do we identify relevant costs or separate them from irrelevant ones? Well, the word marginal is important. Marginal revenues and marginal costs. Something is worth doing if the marginal revenue is greater than the marginal cost. In other words, if the revenue caused by doing something is greater than the cost caused by doing something. Generally speaking, there's not much problem with the marginal revenue. You make some units, you sell them at a particular selling price, you have extra revenue. Marginal costs can be a little bit more confusing, and we have to look at additional costs caused by doing something, or you need to look at opportunity costs, costs which were maybe incurred by not doing something, revenue forgone. Remember, the following costs are never relevant. First of all, reapportioned existing fixed costs. So the overall fixed costs are exactly the same, but because now maybe we have divided them over 2 production lines, it would be in a way irrelevant to burden the new production line with half of those fixed costs. Setting that new production line in the old factory is not causing any more rent. If it's an incremental fixed cost, then it would be relevant, but reapportioning current fixed costs is never relevant. Depreciation is not relevant because it is not a cash flow. What we were looking for to identify relevant costs are future cash flow costs caused by doing or not doing the project. Book costs are historical costs. Essentially they are sunk or past costs. So the net book value of an asset which we are disposing of is irrelevant. That depends both on what we might have spent 5 years ago buying it and what the depreciation has been since. If we can sell the asset, then the cash flow caused by selling the asset is the sale proceeds. That's what's relevant to it. So to get a relevant cost, do the test. Is this affecting the cash flow that would appear on my bank account? Either by causing an outflow, or maybe because we don't sell an item, we don't sell a scrap, by causing the absence of an inflow that would otherwise be there. So it's future costs, it's potential cash flows that we're going to be looking at. Use of scarce resources. This is very similar in approach to what we used when we're looking at capital rationing. So here we have the example, 2 products, here product A, product B. Material available is 1200 units of 1200 kilograms here. So let's see first of all if there's a rationing problem here, a restricted resource problem here. And I think we can see there is. If we make all of product B, that's 5 kilograms, 200 units, that's 1000 kilograms. If we make all of product A, that's 80 at 10, that's 800. To make everything of all products is going to take 2000, is going to take, I beg your pardon, it's going to take 1800 kilograms. And we only have 1200 kilograms, so we're 600 short. So we have to decide, are we going to preferentially make product A or product B? And the secret is to work out the contribution per unit of key factor needed. So if you look at product A here, the contribution is 24. It uses 10 kilograms. So each kilogram we give to product A is earning 2.4. Product B, 15 contribution, uses 5. Every kilogram of this material, this precious material that we give to product B, is earning 3. And 3 per kilogram is better than 2.4 per kilogram. So our best strategy is to make as much as you can, or as much as is needed, of product B. Okay, so therefore make the maximum demand of product B 200. That is going to produce the 200 times 15 will produce 3,000 of contribution. It will use 200 times 5, it'll use 1,000 kilograms, and that will leave us 200 kilograms left out of the 1,200. That 200 kilograms at a use of 10 kilograms each, I think we have an error on this here, is going to be enough to allow us to make 200 at 10, could allow us to make 20. Okay, and these here are going to be generating then at 20 at 24 in there. So it's going to be 20 times 24 contribution is going to be 480. So the total contribution is actually going to be 3,000 plus 480 is going to be 3,480. Special contracts. Special contracts are looking at pricing these up at the minimal acceptable contract price should be balanced to the relevant costs of the contract. The relevant costs are essentially the costs caused by going for the project, and the minimum price should therefore not be any less than that. So here, a simple example, 1,000 kilograms of material X is needed. There are 700 kilograms in inventory, which cost 10 per kilogram. Selling price is now 9. The company has no other use for these materials. More can be bought for 11 per kilogram. What is the relevant cost of the material? Deal first of all with the 700 kilograms in inventory. First of all, the cost we have here, historical cost of 10, is essentially a sunk cost. That's always going to be irrelevant. What we should be looking at here is, if this contract hadn't come along, what would we have been doing with this material? And because we have no other use for the material, we would have been selling it at 9. So if we hadn't used this material in a new contract, we would have been able to generate 700 kilograms being sold at 9. We'd have generated 6,300. We need another 300. This has got our 700. We need another 300. And we have to go out and buy that. So that's a real incremental cost. 311 is going to be coming in at 3,300. So the total relevant cost for this is going to be 3,300 plus 6,300 is going to be 9,600. If this material had been used here, if it's, say, used as normally, so it had an habitual use, then the 700 kilograms that's in inventory would have been used anyway by the company. And all that happens really is, if we take a 700 units and use them as special contract, is we have to go out and kind of replace it immediately with another 700 units to use in the other activities of the company. And if it had had a habitual use, then it would have been at a relevant cost per kilogram of 11, because we have to go out and buy it to keep the other activities going. But at the minute it didn't have any other use, so the best thing we could have done with it was to sell it for 9, and that's what we're going to be losing. Make or buy decisions. Here we have some limited resources, and we have to decide, are we going to make components or are we going to buy them in? And what we should do is to concentrating on making components which are more expensive to buy in rather than making yourself per unit of the scarce resource. So let's look at this here. We have material available, 1,200 kilograms. Product A, the manufacturing cost per unit, is 20. The buy-in cost is 25. And if we're using this material here, we're using 10 kilograms per unit. The maximum demand is going to be at 80. Again, it's like the first example we did. We are having restricted material here. So 1,200, if we gave each of these units here. The maximum is 80. Using 10 each, we could get it through 800 there. In product B here, maximum demand 200. They're using 5 each, is going to be 1,000. If we made everything, it's going to be 1,800, but we only have 1,200. So we're wanting to try and meet our maximum demand, but we're wondering which should we buy in first, so to speak. So if we look at product A, if we were to buy it in, it would cost 25. If we make it ourselves, it costs 20. The extra buy-in cost is 5. Product B, if we make it ourselves, it's going to cost us 25, but the buy-in cost is 35. So these are the extra costs, if you like, from buying in. Or turn it around, saying this is the savings made by making rather than buying. But what we need to work out is the saving per precious kilogram. Okay, so for every saving we make by making A rather than buying it in, we save 5, and we save 10 kilograms of material, because it takes 10 kilograms. Basically, we are saving 0.5 per kilogram. The other one, we're saving 2. Therefore, the best saving comes from making B. So make B yourself, make as much as you can of A, and then for any remaining units of A you need to get up to the maximum demand of 80, go out and buy it. And finally, we have, should we close or continue an operation here? It could be a factory, it could be a shop, it could be the operation in a whole country. So good. Very simple. You want to compare the revenue lost with the cost saved. Okay, so it's worth closing if the cost savings are greater than the revenue which has been lost. It's worth continuing if the cost saves are less than the revenue lost. A very simple decision. Is this closure paying for itself? Are the costs saved greater than the revenue lost? And finally, in this chapter, we look at activity-based costing. So here I've written up the example which is in your notes. We have two products, A and B. Sales volume, 10,000 and 2,000. The marginal costs, 20 and 50. The fixed costs, and I'll assume these have been charged per machine hour, so 50 per hour. So product A takes 1 hour on the machines or in the factory, so going to cost us 50, and product B is presumably costing us 2 hours of machine time, so it's going to be charged fixed costs, the fixed overhead absorption rate at 50 per hour. It's going to be charged for 2 hours. So just remember, I'm kind of saying this is like 1 hour in here, and this is like 2 hours here. This gives us a total absorption cost of 70 and 150, and I've assumed here that their pricing mechanism is a 50% markup. So 50% marked up on the total absorption cost will give us selling prices of 105 and 225. Now this is absolutely conventional marginal costing. This is absolutely conventional costing, in particular where the fixed costs have all been lumped together and all absorbed on the basis of machine time or manual labour time, whatever the fixed overhead absorption rate. There is only one rate. What activity-based costing does is to say, well, is it really fair to lump all costs together and say that they are all generated or should be charged back to products simply on the basis, say, of machine time? And what activity-based costing wants to get to, it wants to get to what's called a cost driver. What activities drive the cost? I actually prefer to use the word cost causer. What costs cause, what activities cause these costs to be incurred? What we've done for this example is to say, well, we've just identified one specific cost causer, and that is setups, that we have to stop the production line every now and again and to rejig the settings, set up the machinery again, so they can make another batch of product A or product B or whatever. So I've said that they have got here what's basically a cost pool. I've said that 30% of total fixed costs are for setups. I would assume that the other 70% can still be assigned to products on the basis of machine time. But for the 30% fixed costs relating to setups, we want to assign them to do with how you benefit from a setup. So we need to find out what are these costs are, and then to begin to kind of put them into the products, if you like. So what are the total budgeted fixed costs? So the total budgeted fixed costs that we have, we're going to be making, we think, 10,000 of product A, and it's got 50 each. That'll be 500,000. And for product B, we're budgeting 2,000. It's got 100. So we're going to have in there presumably 200,000. $700,000. That's your total fixed costs. And we're saying that 30% of that is setup. So 30% of that's going to be 210. So that's your 30%. And the rest of it, the 70%, is going to be 490. And we're going to treat these differently. These are distinctly different sets of costs. Note that if you go to activity-based costing, we're only ever meddling with fixed costs. It's nothing to do with marginal costs. Marginal costs are always easy to deal with. You know, so many kilograms at such and such a kilogram, so many hours at such a pay rate per hour, and so on. It's only ever fixed costs that we're arguing about here. Setups. So we have incurred 210,000 cost here because of setting up machinery. And I think we have to put on some more information here about what sort of setups we have. And the information that we need here is we'll say that product A is produced in batches of 1,000 units. So batch size will be 1,000. And we'll say that the batch size in product B is 100. So product B is low volume product produced in small inefficient batches, if you like. Product A, large volume product produced in big batches of 1,000. Every time we stop and set up for a batch, we're incurring a setup cost. So how many setups are there? So we have to get through 10,000 units. And we are getting through in batch sizes of 1,000. There must be 10 setups there. The other one, we're getting through 2,000 units, and we're setting up in terms of 100 there. So that looks like 20, doesn't it? So the total number of setups is 30. So we've got 30 setups, and they cause this 210. So 210 divided by 30 must be the cost per setup. It's coming out at 7,000. But what do we get for our money? We've stopped the machinery, we've incurred a cost of 7,000, and for that cost of 7,000 we are getting 1,000 units of A. Okay, So for A, the cost of a setup is 7. For B, we stop this machinery again, it's costing 7,000, but we're only getting 100 out of that. It's going to be 70. So a vast difference in the bother, if you like, which product B is causing in terms of setups. We have the 7,000 incurred, but then we get very little for our money. We'll come back to that where we'll reconstruct the whole total absorption cost again, but let's just look at this other amount in here, this 490,000 here. We have to assume that's going to be split the same way as before. It's going to be split on the number of hours of the production. So no discernible cause. We go back to the old fixed overhead absorption rate here. So the number of hours needed to produce your 10,000 units of A, if there's 1 hour each in here, will be 10,000 hours. And the number of hours needed to produce your 2,000 units of B, we said it was 2,000 at 2, it's going to be 4,000. So the fixed overhead absorption rate for the rest of the fixed costs that haven't been separately identified with a cost driver or cost causer, it's going to be 490,000 divided by 14,000 is 35. 35 per hour. Okay. So let's reconstruct our costs and indeed our selling prices again. So we had our A and B. We have a marginal cost which is not going to be altered at all. So the marginal cost here was 20 and 50. We have the setup costs. And the setup costs, big difference, 7 per unit and 70 per unit. And the other costs, other fixed costs in here, remember it was per hour, so it's going to be 35 in here. So 1 times 35 there, because it only took 1 hour. And we're going to have 2 times 35 in there. That's going to be 70. So this is coming down to 55.62. This is coming up to 140, 190. And if we look at our cost plus the 50% markup, selling price, so the markup will be 50%, be 31 in there, and there's going to be 95 in there, isn't it? So we're going to be coming up to 93 for our cost in that one, and 285 there. Compare that to the previous one, where we had a selling price of 105 and 225. So one of the things that activity-based costing is reckoned to do is reckoned to be much better for pricing. That if you don't know your costs properly, how do you know what selling price to charge? And here we have recognized that product B is quite troublesome, quite an expensive one to be making here at 190. And we need to make sure we earn adequate profit there by selling at a decent selling price. 285. 225 is a bit low. 225 in a way is not really doing much more than covering the cost. The old selling price is very, very low indeed. Similarly, we'll be able to lower the selling price of A. Maybe we had overpriced it. It's all very well saying put a high selling price on, but if nobody wants to buy it at that price, you're not much better. Second thing to note from activity-based costing is that if you don't understand your costs, you can't control costs very well and you can't optimize profits. And the place to look for high costs the first place to look for savings is going to be where the costs are particularly high. And looking at this here, you see there's now like a times 10 difference in there. Okay, B is more expensive in all sorts of ways. The marginal cost is greater, the other fixed costs are greater, and so on. B is a different product. But, going from the times 2 in terms of other fixed costs to times 10 in terms of the setup costs, surely something might be doable by that to make it more efficient. And if we were, instead of maybe making small batches of 100, is there any reason we couldn't make batches of 200? And if you made batches of 200, you would very substantially reduce that cost, winning huge efficiencies, maybe in a very, very easy way.